You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, Jim, good morning to you, and it's certainly a lovely day here in Vancouver.
I guess things are going better in Russia. They've cut their central bank rate from 17% to 15%, so everything's good in the land of pierogies and cabbage rolls.
Oh, wow, these central bankers are amazing. There's something philosophical here. And that is that let's use the Federal Reserve as the example because it was set up in 1913. And because policymakers noticed that if you had a bad stock market and credit was tightening up, it would be followed by a recession. So then, in their wisdom, they decided that if you had a central bank that would be there to ease credit at the appropriate time and prevent a recession or prevent the stock market setback, then you wouldn't have a recession. Now, that was back to 1913, and there's been, I think, 20 recession cycles since, so they're not very good on their promises. But then you look at it another way, that they have this state has granted them the right to create credit out of thin air, which actually does depreciate the currency. Now, if they weren't doing that, the markets would create whatever credit is necessary, and markets on their own can't depreciate currency. It's only relentless efforts by central bankers. So if a central banker did sound banking, you wouldn't need them. So then they exist only to do unsound banking. And in Canada now we have a particularly interesting thing where the reputation of Canada and Canadian Central Bank was quite good following the '08 crash and all that. It didn't get as panicky as elsewhere. So, but here now, the governor of the Bank of Canada recently took a look at falling crude oil prices and said, oh, I have to fix that, and cut the administered rate by 0.25 percentage point. So what has happened is some of the big Canadian banks, the commercial banks, were reluctant to go down because, you do want to ration credit through interest rates and credit quality. So they've been reluctant to decline, and I think the commercial banks are showing judgment, and I think the Bank of Canada is throwing away a reputation, and because it'd be futile. Canada's problem now is a falling dollar, and it's screwing most people. Sure, it'll help exports, but the global economy is probably shrinking, and the prices are falling for commodities in many currencies. It's falling. So there's no way that the Bank of Canada can depreciate the currency fast enough to offset weak commodity prices. So it's absolutely absurd. But let's leave those jerks to themselves and try and ignore them.
So how do we work around this weak loonie and take advantage of what's happening in the bond and equity markets?
Well, if you've got assets, they'll be going up. But, even you take a look at the chart on the Royal Bank stock in Toronto, where it's quoted in Canadian dollars, the chart is breaking down. And if you look at it in U.S. dollars, it trades in New York, it is heading south fast. So this is always, depreciation is an artificial prosperity, and so we have to suffer it. So, but the problem is, it's been making this in the experiment in lowering interest rates through buying bonds. Formerly the Federal Reserve was, and then now the European Central Bank has picked it up. But you take a look at the German 10-year note, it's down to what I looked at yesterday, I think 0.35%. Now, you don't have investors buying a 10-year note for income. So the instrument exists solely to speculate in, and there are two sets of speculators. One is the guys at the European Central Bank who are speculating in a theory that if they buy enough bonds, they'll get good economic growth and commodities will go up. I doubt it. Then you have the other set of speculators who are trading these instruments, and there's no investors. Investors you can't buy. And then, of course, you got a extremely low coupon on these things. So when the yield goes down like 10 basis points, the price of a 10-year bond would go up by a full point. And then it grinds the other way. Very low coupon bond really gets amplified moves. So when the bond market reverses, it'll be very interesting. And we've been monitoring this on the long-dated U.S. Treasury bond. It's been soaring. The rise has been steepening for the last number of months, and it's getting up to some pretty high momentum numbers. For the last month or so, we've been calling this ending action, that the move will probably go far enough to blow out and end the whole era of speculation in bonds that have driven yields down to never land. You know, typically in the senior currency, in the 1940s, it was the U.S. dollar. Prior to that, the senior currency was pound sterling. And on your secular lows in interest rates, which would occur as each long depression ended, would be about 2.5%. And that was even at times when both countries had a gold-backed currency. So then now you've got the German 10-year note down to 0.35%, and it's not gold-backed. So, and then you've got Spanish at less than 2%. I mean, these numbers are absolutely absurd, and there's no way that Mother Nature and the financial markets can allow such absurdity to run forever. So here's our theme. It's running forever, but it's ending action. So we're waiting for the end of the month numbers. I guess that's this for today. And then over the weekend, we'll plug them in and see what the technical models are telling us. And I'll be looking forward to see what's happening there. So, but we do know that back in the first half of last year, there was a strong urge around the world to buy lower grade securities. And then that, in the sense of junk bonds in the U.S., and that drove the yields down pretty good and gave us a good momentum reading. Let's look at the bond price. It was rallying. A good momentum reading in June, which is sometimes a fateful seasonal month for reversals, and it did reverse. So and actually right down until recently, there was pretty heavy selling pressure. But the last couple of months, these things have come up. They got oversold. So anyways, there has never been interest rates this low in all of financial history. You know, it is that remarkable. And so it won't be resolved easily. This is going, of course, part of the game is going the other way, is that the strong U.S. dollar, and this fits into a post-bubble pattern. We consider that the big bubble and speculation in stocks and commodities and whatnot in 2007 was a 1929 type of market, and you had a very serious sell-off that followed, and then now have been on the first business expansion out of a fairly typical crash, and now everything is highly elevated and looking for a way down. But the point to be made is that in every post-bubble contraction, the senior currency has become chronically strong against most other currencies and most commodities for most of the time. And we'd add in that this varies according to the business cycle, because in a positive business climate, commodities will be bid up. And then when you're heading towards the next recession, commodities will be bid down. And you have the CRB index at new lows from the high in 2011. You can look at commodities like iron ore, same thing. You can look at a commodity index of industrial commodities without crude oil in it, new lows for the move. So this must be driving central bankers nuts, because they've all been highly reckless in easing credit, and it's not hooking up into the commodity side. We don't see anything yet that would say that the bear market in commodities was close to ending. Sure, on crude oil, we had like once it started to fail, we looked at the old breaks in crude, and 6 to 7 months you can have pressure on it, and January has been the 7th month, so a number of weeks ago it looked like it wanted to take a pause for a while, and that's the way we wrote it up, just a pause in a bear market. And then I think yesterday or the day before it was threatening that old low, so that's not over. But I think, Jim, the big thing is that the recipe whereby both central bankers and gold bugs and inflation bugs figured that a central bank with the ability to depreciate the currency, it's always going to end up in driving gold and silver up, as well as other commodities. And they've been depreciating, easing credit and throwing it out the window with helicopters and all that sort of stuff. But you've had a very important bear market in commodities since 2011. It was a very excited blow off there. And crude oil, it hit its high in '08 at $147. And now it's sort of, what was it yesterday? 44, something like that. So I think if I was a central banker, I would be extremely puzzled by all this action. But then they have to put on the front that they know everything and are in control of everything. And so let's just let Mother Nature work its way. We think that our advice back in the middle of the year was to for fixed income investors was to get out of the junk and go then to for investors to 3 to 4 year high grade corporate bonds in the U.S. because then you'd get not much yield, but you get a pickup on the currency with the U.S. dollar strengthening, and that turned out to be a very good trade because the Canadian dollar has fallen 15% in a rather quick time. And then the other one would be speculators in long treasuries to kind of let it run for a week or so yet, see what happens. But I'd be dancing close to the exit on the treasury market.
And we'll take a look at gold when we return with Bob Hoye.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to market historian Bob Hoye. Bob, what's happening with gold?
Yeah, well, it had the big bull market ended. It was virtually a decade-long bull market ended in 2011, and we have an indicator on gold and silver that anybody can use, and that's the silver-gold ratio. And in any bull market for precious metals, silver will outperform gold. And as you get to the top with all the excitement, silver really flies. So you keep track of the momentum on the silver-gold ratio. And in 2011, it got up to 92, and the last time it was there was in the height of the crazy speculation that concluded in January 1980. So we advised that it was highly dangerous and speculation, and that the setback would not be as bad as what followed 1980, but it would be bad. So here we are. So back in November, we noticed that, or wrote out that what we needed to get a bottom in the gold market would be the gold shares themselves beginning to outperform the metal price. That started to happen. And then the other one was that silver would begin to outperform gold, but not too much, just a little. So gold and gold stocks, silver, etc., we have set rather a good bottom. And then what happened last week is that everybody got on board. Commitment of traders figures got really stretched, and we had some momentum in the play. So over the weekend, Chartworks came out and said that gold could break perhaps down to 1,200 to 1,225 in there somewhere, and it's fast. This is, I think, another part of setting a bottom for both the metal and for the gold shares. So what's leading this, of course, is we always talk about, is gold's real price, and that is an indication of whether the gold miners are making any money. If they say the cost of mining, including energy, crude oil prices, are going up faster than the price of gold, they're not making any money. So at any rate, the calculation of the U.S. CPI is kind of suspect. So many years ago, we decided that we'd use a gold divided by commodities index as a proxy for gold's real price. And that set what turned out to be a cyclical low in June. It's interesting that it turned as the credit spreads turned. And that's what happened in 2007, where in May, June of that fateful year, the real price of gold turned up after being depressed, and the credit spreads and junk bonds turned down after being highly elated. So we've got the same move here. So anyways, the gold's real price has continued to move up. It's had some corrections on the way, and so it's now a strong chart, and it reflects improving profitability for the gold mining business. It also, as it continues, will reflect better valuations for gold deposits. So it'll help the exploration side. So let's put us down here as long-term bulls on the precious metal sector, and we would use the correction that's on now to add a little to positions, because as the market was bottoming, our advice was to accumulate some on weakness, but we didn't commit to a full position yet. That opportunity will come. So it's good to look forward to at least one place where there could be a very good cyclical bull market, and that would be in the precious metal sector.
Bob, thanks a lot for chatting with us.
Always good to be with you, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. You can forward comments to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.